our starting point on a lot of these metrics is actually quite different. So if we start with the first chart, we're just comparing and contrasting forward PEs for the S&P 500 versus the MSCI EM index. And of course, one thing that jumps out at you, and this goes back to Jan of 17, of course, the first Trump administration, and rolls through the end of 2024. And one of the key things, of course, you can see is that blue line being the S&P is up, and it's up quite a bit. And in fact, it's basically one of the highest points it's ever been. So at around 22 times forward, there's really only two other points that were meaningfully higher than this. One is on the chart, kind of 2020, 21. And then, of course, if you go back to, really 1999. So there is a lot of sentiment that is very positive. Of course, a lot of things have accrued in a very positive way to the U.S. and for good reason, right? You've seen very strong returns on the back of very strong earnings growth. We know what's happening in Mag 7. We know that there's a lot of the US cohort that are these AI beneficiaries. And so a lot of that sort of, makes sense. But as we again compare and contrast, you can see that the orange line in MSCI EM really hasn't moved. It's sort of trading at about 12 times forward. And as it's basically always kind of traded at a structural discount to the S&P 500, I think what's more interesting is that relationship, right? And that's what you've seen move more recently, is that gap, that forward gap between the US and EM overall has actually started to grow. Again, some of this makes a lot of sense if you're thinking about it in aggregate, because deregulation, potentially better monetary policy, all these things, that should on net be pro growth and a good thing.